In this episode, we speak with Tyler Wolfram, a managing partner at Oak Hill Capital, a longstanding private equity firm that has been investing in the North American middle market for nearly 40 years. Oak Hill applies a specialized theme-based approach to investing across services and digital infrastructure. Since 1986, Oak Hill and its predecessors have raised over $23 billion in initial capital commitments and co-investments, and have invested in more than 110 companies. Tyler has been a managing partner at Oak Hill Capital since 2012, and has been with the firm since 2001. Previously, he was a managing director at J.H. Whitney, and spent the early part of his career at DLJ. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of Growth Cap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Tyler, thank you so much for taking the time to chat with us today. It's a delight to be with you.
Thanks for having me, RJ. Appreciate the opportunity.
So I thought we'd start with a softball question, but a meaningful question. You know, I've done hundreds of these interviews, and as I do prepare and research the firm and some of the background, I like to understand really like the DNA of what makes the firm tick. What I noticed, which was something unique about Oak Hill, was a quote, I think, given by the founder: doing well while doing good. Can you tell us about how that quote influences the way the firm runs?
Sure. So I think, the history is pretty interesting because the firm Oak Hill has been around now. This is our 40th year of being in business. And we started as a family office. So the mid-late 80s, we started just investing Robert Bass's capital. And Bob was one of the early pioneers of the industry. A number of very successful people have gone through the Bass organization that got started with his capital. And then we started to evolve into a more institutionalized firm. In the late 90s, we raised our first institutional fund, and I showed up right about halfway through the first institutional fund. So I've seen the whole history and evolution for the last 25 years and been part of that. I think at the foundational level, when you start by investing a founder and entrepreneur's capital, you think like business owners, you think like value creators, you focus on building strong franchises. We've been less focused on building asset aggregation model. So it's interesting that after 40 years, we do the same thing, which is middle market investing in the United States. We just try to do it as well as we possibly can. And at the foundational, sort of the principles level, Bob did have that. It was called doing well to do good. And before there was even a term around ESG or responsible investing, and we don't shy away from the priorities and the attributes that guide us there, even though it's not quite as topical for some people today. But doing well to do good meant that we wouldn't touch businesses that we thought had a predatory element, to face the environment, anything like that. These became more formal policies down the road for many, including ourselves. And we were at the forefront of all of that. And so it's basically about being a good partner, transparency, economic alignment between us partners, with us as our limited partners, as well as our CEOs and management teams. So there's some just foundational belief system here that still continues with us 4 decades later.
I noticed your firm also focuses on the 3 types of capital, not just financial capital, but human and creative. And just touching on that first vertical of human capital, how does that play out when you're actually interacting with a portfolio company and trying to help them grow, in a long-term fashion?
So I'll just give you a little bit more history on that. So we went through our succession planning process in 2012. I was elevated to the role of leading the firm, and we together started to position the firm and think about how we would operate our business and what our priority system was going forward. And we went through this long exercise, this process that we used to transform businesses that we had worked with in the past. I felt like if that was good for a business, it was good for us. And you can imagine private equity guys roll their eyeballs at doing something like this. But we went through that exercise anyway. And we had at the top of the pillar, at the top of the pyramid was bold, ambitious, collaborative culture with a soul. And so we put talent first, we put culture first. And that then resonates not only how we operate with ourselves and our limited partners, how we partner and behave with our CEOs. And it starts with some very basic principles that have been around with us for 4 decades. It starts with having shared values. It starts with having transparency and alignment in the relationship. That can be economic alignment. Importantly, can be alignment around the value creation plan. And then it includes a high degree of transparency. Things don't always go well in this partnership. Let's be transparent and open and honest. And we just try to be good partners and good people. We try to define that value creation plan. If there are certain needs the company has, we at the firm, our strategy is to be subject matter experts, and we can get into that at any time. But we wanted to partner with these CEOs, bring the resources that they believe they need. We don't force them on these individuals, and just share collectively in the ups and the downs from there.
And how often is it that you are looking to partner up with a distinct CEO for the long term versus coming in with a mindset of, let's see how this partnership goes, and potentially we either augment the management team or replace the CEO? Is it imperative to have like that CEO installed for the foreseeable future?
We generally are partnering with the CEO, or in many cases, the founding family. There's often a lot of business building and team organizational building along the way to achieve the outcome we want. I think one great example would be a company we partnered with back in 2014 called Metronet. We were early to the game in believing that fiber was going to be the prevailing and the winning technology, and there was a huge runway to build out that fiber infrastructure in the United States. Today, we own 10 companies building out fiber. And based on our research and publicly available information, we believe we're the third largest residential builder of fiber per year in the country, behind AT&T and Verizon. But back then, this was a nascent, evolving area. We partnered 50-50 deal with the Sinelli family. So to partner 50-50, no one has the edge over the other. You have to believe together we're going to make good decisions, and we have the common vision. And we started executing the plan. And during that course, over the last 10 years now, I guess it's 11 years, we ultimately invested $1.2 billion of capital across multiple funds. We helped build that business with the management team from 88,000 homes passed to last year over 2 million homes passed, and they've publicly stated an objective to get to 6.5 million homes by 2030. That required a lot of business building, a lot of collective partnership, alignment. We recently recapitalized the business with T-Mobile for $10 billion enterprise value. So there was a lot of learnings along the way. It wasn't a complete straight line, but that was kind of the Oak Hill thematic work in process. And because of that learning experience, that enabled us to buy and invest in a partner in all those other fiber businesses along the way.
Now, you focus on two distinct areas in digital infrastructure and services. I'm curious how the firm has evolved with its focus from when you joined to where it is today. Like, have the focus areas evolved?
I think, when you're a family office, I mentioned there's a lot of wonderful principles, foundational elements. The one thing, though, as a family office, you can be rather eclectic in your investing. The goal back then was generally apply a thematic approach, generate attractive risk-adjusted returns. And the way we interpreted and processed that was a lot of different flavors. There was not as much consistency around the asset profile and the deal profile. And over time, that has really evolved. So today we take a much more thematic and systematic approach to this investing activity. And everything we do is designed around creating long-term institutionalized success. And so over time, you learn a lot about yourselves. You learn about what themes work. You learn about the asset profile and the targeted return distribution and risk level that you're comfortable with. And so that has led us to the areas that we focus on, which are digital infrastructure. Think of it as digital infrastructure plus, which has been mostly building out the infrastructure in the US where we can generate alpha, not core infrastructure type scale returns. Financial services is also about 25% of the pie, with digital infrastructure being roughly 25-30, financial services roughly 25 or so. And then the balance is what we call essential services, which are diversified across industrial services, consumer services, and business services. But what drives everything in how we operate as a firm is identifying and underwriting these long-term, high conviction, durable investment themes where the power of that secular tailwind will offset any type of macroeconomic choppiness along the way.
Mm-hmm. And in the beginning of our conversation, you mentioned that you're not as much about acquiring other businesses or aggregating assets in that fashion, and you're more about building the primary business. Do I have that correct? Because it does seem like a more of a unique and nuanced approach.
Well, just to add some clarity around the definition, when I say we're not asset aggregators, it means like we do one thing, middle market investing, private equity in the US. We don't have a credit fund. We don't have a this fund. We don't have a that fund. And look, we started around the same time. Many of the megas started their businesses. They've chosen different profiles, different strategies long term. There are a number of businesses that got their start inside Oak Hill or the Bass organization, but they're run separately, managed separately, owned separately. So there's a big credit business that's run separately by Glenn August called Oak Hill Advisors. There's a real estate business and so on. But we just stay pure to middle market investing, which was the original foundation of the business.
Mm-hmm. And now this other element to capital is creative capital. And in some cases, firms have certain playbooks. Always playbooks can change. And sometimes people are shying away from that term because it seems too formulaic. How do you think about value creation when you go into a situation?
It's super important for us upfront to agree with the CEO what the value creation plan is. We seek assets where there are multiple levers of that value creation. Not everything works the right way at the right time. You could pull on certain levers harder at various points in time. So that's super important. Our objective is to try to double or triple these companies in size. And so we start with that. And then we look at these businesses and say, okay, what do we have to reinvest that high free cash flow back into to drive that type of growth? We want to make these businesses stronger franchises when we're done, more relevant to those themes we're playing, and we'll figure out the optimal way to exit. So then we go back and say, okay, what do we have to invest in? What's the proper capital structure? So I think if you look at our funds 4, 5, and 6, average leverage is around 4.6 times. Average leverage in fund 6 is 3.2 times. And so without looking at everybody's data, because I don't know it, but I think this is generally lower than the average for private equity, LBO focused type firms. And I think that's somewhat unique. It doesn't mean we don't have an aversion to leverage, but many of our businesses require investment to get to where we want them to be at the end of the investment horizon.
Mm-hmm. One thing we like to touch on during these interviews is personal background. I noticed you were an athlete in college, and I like to touch on those early kind of experience to see how it influences people later in life. You can go back even further just to tell us a little bit more about yourself. And were you always playing football?
Yeah, I mean, look, I played 3 sports growing up: football, baseball, basketball. I was the oldest of 4 kids in my family, immigrant family, and all 4 kids played sports in college. 3 of the 4 played multiple sports in college at a high level. So it's always been important. I just think that the lessons and the virtues you learn as an athlete are super important and useful later in life. You know, you have to prepare to do your best. You have to be okay with failure and taking risk. And when it happens, you have to recover. And these are all important things to learn, obviously, later in life, especially professionally, when you're in the risk-taking business. I sort of serpentined my way to business school. We don't have enough time to talk about how I got there. But coming out, I started my career after business school at Donaldson, Lufkin and Jenrette, which at the time was an amazing place, super entrepreneurial, a lot of success and a lot of fun. And I think back in my early days, I was lucky enough to be exposed directly to Tony James. I worked very closely with Tony in certain situations. And back then at DOJ, you sat around a little table in Tony's office, and maybe Garrett Moran or Bennett Goodman, a few others were there at that table. And you talked about the deal you were doing and the risk. And in most cases, the young guy was there who was running the models, and that was me. And Tony took me under his wing, asked me to manage the analyst program. So I was in charge of 130 people across multiple offices, hiring, firing, staffing, dealing with their personal problems, and ultimately compensating them. So it was my first foray into learning what managing a little bit a financial services business looked like. And then, I was brought to Oak Hill by one of the bosses I had at DLJ at the time. And 25 years later, here I am.
We have a lot of folks who listen in, and they're typically in the investing world, growth equity, private equity. They're at different stages of their career. If there was like one piece of advice you could give to other investors, and they could be either, within a big private equity organization, or they could be running their own fund, maybe like a, low billions fund. What piece of advice would you give someone to be successful long term in this business?
Well, if they were leading the organization, certain pieces of advice, and a lot of this input I got over time was with CEOs I partnered with on deals who became super influential to me and helpful to me in this role when I stepped into a leadership capacity. I think it starts with having a clear vision of where you want this firm to be longer term. And setting that vision, you have to be able to inspire others and you have to empower others to help you get there. And often that means exposing some level of vulnerability. Like we have to be confident, clear. However, I think it's okay, and I did this myself, to say I'm not exactly sure how we're going to get there or how we're going to overcome X, Y, and Z. I need your help. When you ask others for help in certain things, it empowers them. It creates an element of ownership and accountability. And I think about some of those basic principles, like where we are at Oak Hill today. Okay, so it's pretty unique to be at a firm 40 years in the making, where the people at this organization today have their fingerprints on what we call Oak Hill 2.0 looks like. Oak Hill 1.0 was investing Bob's money in the first phase of institutional capital. We own Oak Hill 2.0, all of us together, the 50 people at this firm. And most of the people here today helped us reimagine what Oak Hill could be, helped us execute 9 months of multiple workshops to start that process. No one loves those things. I don't either, but it's necessary. And people feel a sense of fulfillment of having gotten to where we got to, but also a sense of pride. However, every organization can never be complacent. Complacency is a real risk in private equity over a long period of time. You have to obviously always evolve. And we constantly are trying to do that in different ways.
Mm-hmm. What's the toughest challenge you face where when you look back at it, it gives you a sense of satisfaction that you were able to deal with that challenge and come out the other side?
I'll reflect on my time here at Oak Hill, because when we raised Oak Hill Capital 4, it was a 2016 vintage fund. The firm had not had a fundraise since the prior raise, which was 07, 08 type capital raise. So it had been a long time. And we had a very new and different, we thought, exciting story to take to the market. But it was a story of transformation and evolution. We try not to use the word change because people think of that as risk. And I spent about 2 years marketing the idea that complacency is risk, change and evolution is opportunity. Together as a firm, we ultimately exceeded our hard cap on that fund. It took a long time, and that really started the basis and the foundation for what we call now today Oak Hill 2.0. And I just think back to those times, the struggles, the 1,000 or so meetings, the sacrifices along the way. Man, that was tough. I feel proud. The entire firm feels proud to be where we are today.
Excellent. We're entering the tail end of the conversation. I have two final questions. One is, can you tell us about a person who has had a profound influence on you?
Sure. I would probably say, look, my father in particular, he was the youngest of 6 kids, the only one to go. They spoke German in his household. He went to college, and here we are today. And the only career advice my dad gave me, he's a linguist, he's a professor, he's 85 years old. He still teaches every day. He does documentaries and just came out with his 25th book. The only advice he said was, son, I don't care how successful you are. I don't care how rich you are. I only want you to have a job where Sunday night you don't dread going to work the next morning.
Mm-hmm.
And if you have that, you can work for a long time and be quite satisfied, and hopefully success takes care of itself from there. So there was a lot of lessons I learned being the oldest child in that situation, but that was kind of the first start of any professional advice I got.
That's excellent. Last question. Can you tell us about a charity cause or other endeavor that you're passionate about?
Sure. I'll connect that question back to the first question about athletics. And it's just an important part of my life, my family's life, for a lot of different reasons. But for 11 or 12 years, I coached youth football here in Greenwich. I coached 4 days a week. I studied film. I had to leave the city early to get back out. We didn't have as much remote capabilities back then. And I had to just make the sacrifices to get there. And that started with, I had a vision for what I wanted my life to look like. And I said, man, I want to have proper work-life balance, but also be successful, which is super hard. I want to invest in my family, my relationships, my community. That was a way for me to give back in a way that I thought I had unique capabilities given my background. And I got to coach my kids in the community. I see people that are now adults say, hey, Coach Wolfram. And so to me, that was a powerful way to give back. It was super time consuming, but man, I got so much out of it.
That's wonderful. Well, Tyler, I want to thank you again for taking the time for this conversation. It's been a great one.
Thanks, RJ. I really appreciate it.